You just put $100 into the stock market. Right now, today, one version of you buys a company that pays you cash every quarter. The other version of you buys a company that pays you nothing and reinvests every dollar into growth. 30 years from now, one of these choices makes you dramatically wealthier than the other. The answer isn't what most people assume. Here's what actually happens. Dividend stocks feel safer. They feel like proof. A company that hands you cash every quarter seems like a company that's telling the truth about its health. Growth stocks feel like a gamble. No cash in hand. Just a promise that the value is compounding somewhere inside the business. But feelings and outcomes are not the same thing, and the data tells a very different story depending on what era you're standing in and how long you're willing to wait. Let's start with what a dividend actually is. When a company makes a profit, it has two choices. It can send some of that profit directly to you as a shareholder in cash on a schedule, or it can keep the profit and pour it back into the business. New equipment, new hires, new products, and acquisition. The first path is a dividend. The second path is reinvestment. Neither path is automatically better. It depends entirely on what the company can do with the money. Think about it like a garden. A mature apple tree doesn't need to grow taller anymore. It's already at its full height. So instead of using its energy to grow new branches, it spends that energy making apples you can pick and eat right now. That's a dividend stock. A young sapling, on the other hand, hasn't reached its potential yet. If you pick its fruit too early, you're stealing energy the tree needed to grow into something much bigger. That's a growth stock. Neither tree is wrong. They're just at different stages of life. Now here's where it gets interesting. Jeremy Siegel, a finance professor at the Wharton School, spent decades studying stock returns going back to 1871. What he found surprised a lot of people. Dividend-paying stocks, especially the ones that consistently raise their payouts, often outperformed non-dividend payers over very long stretches of time. Why? Because a company that can reliably pay and raise a dividend is usually a company with real, stable, repeatable profits. It's not hype. It's not a story about the future. It's cash, in the bank, proven quarter after quarter. But growth stocks have their own case, and it's a strong one. Eugene Fama and Kenneth French, two researchers whose work reshaped how modern finance thinks about returns, found that smaller, high-growth companies can deliver outsized gains precisely because they're reinvesting instead of distributing. Every dollar that isn't paid out as a dividend is a dollar still working inside the company, potentially compounding at a higher rate than you could get by taking the cash yourself and reinvesting it elsewhere. If a company can turn $1 of retained profit into $2 of future value, keeping that dollar inside the business beats mailing it to you as a check. So which one wins? Here's the myth you need to let go of first. People assume dividend stocks are safe and growth stocks are risky. Full stop. End of story. That's too simple. A dividend can get cut. It happens more often than people expect, usually right when a company is struggling and needs cash the most, which is exactly when investors were counting on that income. Growth stocks can also stall out completely, especially if the company never turns its promised potential into actual profit. Neither label, safe or risky, tells you the whole truth on its own. What actually separates the winners from the losers isn't the dividend or the lack of one. It's what the company does with its capital. A company that pays a dividend because it genuinely has nothing better to do with the cash is making a smart, disciplined choice. A company that reinvests because it has a real, provable path to higher future profits is also making a smart, disciplined choice. The mistake is a company that pays a dividend it can't actually afford just to look reliable, or a company that reinvests endlessly into projects that never pay off. That's where the real risk hides. Let's walk through a real-world scenario. Imagine two investors, both starting with the same $10,000 in 1990. Investor A buys a basket of steady, established dividend payers, the kind of company that's been in existence for decades and reliably raises its payout every single year without fail. These are sometimes nicknamed dividend aristocrats, companies with a track record so consistent that investors build entire strategies around simply owning them and doing nothing else. Investor B buys a basket of aggressive growth companies reinvesting every dollar back into expansion, offering no cash at all, just rising ambition. For the first several years, Investor A feels like they're winning. Cash is landing in their account. It feels real. Investor B watches their portfolio swing wildly, with no cash coming in at all, just rising and falling numbers on a screen. There's a psychological weight to that difference that spreadsheets don't capture. Getting paid feels like being right. Watching a number fluctuate with nothing landing in your pocket feels like being wrong, even when it isn't. But stretch the timeline out. Robert Shiller, the Yale economist known for his long-run studies of market valuations, has shown that returns over decades are dominated less by short-term swings and more by the power of compounding and reinvestment. If investor A reinvests every single dividend back into more shares, instead of spending the cash, their portfolio actually behaves a lot like investor B's. The dividend, reinvested, becomes its own form of growth. This is called a dividend reinvestment plan, or DRIP, and it's one of the quietest wealth-building tools in existence. Instead of the company mailing you a check, that check automatically buys more shares of the same company, which then earns its own dividend next quarter, which buys even more shares after that. It's a snowball that most investors never bother to notice is rolling. Meanwhile, if investor B's growth companies mature and eventually start paying dividends themselves, once their own growth slows down, the line between the two strategies starts to blur entirely. This is the part almost nobody tells you. Dividend versus growth isn't really two separate paths. It's one long path with two different stages. Almost every company that pays a strong dividend today was once a growth company that didn't. Almost every explosive growth story either eventually matures into a dividend payer or it fails to survive long enough to become one. You're not choosing between two permanent categories. You're choosing where on that life cycle you want your money sitting and how much patience you're willing to bring to the table. There's a pattern hiding underneath all of this that most people never notice, and it has to do with which industries tend to fall into which camp. Utilities, consumer staples, established banks. These sectors show up again and again on dividend-focused lists. Why? Because people need electricity, toothpaste, and groceries in good years and bad ones. Demand doesn't swing wildly, so profits don't swing wildly, and a steady profit is what makes a steady dividend possible in the first place. Technology and biotech, on the other hand, dominate the growth camp. A software company or a drug developer might spend years, sometimes over a decade, losing money on purpose, betting everything on a product or a breakthrough that could eventually be worth far more than the cash they burned getting there. Neither industry is better. They're just playing different games with different timelines. This is also where a well-known behavioral bias creeps in, one that has nothing to do with spreadsheets and everything to do with human psychology. Investors tend to overweight what they can see immediately. A dividend check arriving in your account is visible, tangible, undeniable proof that something happened. A stock price ticking upward inside a portfolio you don't check very often is invisible until you decide to look. Daniel Kahneman, the psychologist whose work on decision-making reshaped how economists think about investor behavior, described how people consistently give more weight to immediate, certain outcomes than to larger, uncertain ones further away, even when the math says they shouldn't. That's part of why dividend investing feels emotionally safer, even in years when the growth strategy quietly outperformed it. The feeling of safety and the reality of safety aren't always the same thing. There's also a quieter factor that changes this whole equation, and it has nothing to do with the stock itself. It's the account the stock sits in. Dividends are usually taxable the year you receive them, even if you immediately reinvest that cash back into more shares. That means a dividend-heavy strategy inside a regular taxable brokerage account can quietly create a tax bill every single year, whether or not you ever meant to touch the money. A growth strategy, by contrast, doesn't trigger that same yearly tax event because there's no cash being distributed to tax in the first place. The gain only becomes taxable once you actually sell. Inside a tax-advantaged retirement account, this difference mostly disappears. But outside of one, it's often the single most overlooked variable in the entire dividend versus growth debate. So what should you actually do with this information? Start by asking yourself a simple question. Do you want cash flow now, or do you want maximum growth later? If you're decades away from needing the money, growth-oriented companies reinvesting their profits often have more room to compound, especially inside an account where you're not paying taxes on dividends you don't even need yet. If you're closer to needing income, or you simply want the psychological comfort of cash landing in your account on a schedule, dividend payers earn their place too. as long as you check that the dividend is actually sustainable, not just a number that looks nice on a chart. Either way, the single most powerful lever in either strategy is the same: reinvest. Whether it's a dividend check or a company withholding its own profits on your behalf, the real engine of long-term wealth is compounding. Money making money, quietly, for years, without you touching it. The investors who build the most wealth aren't usually the ones who correctly guessed dividend versus growth. They're the ones who picked a reasonable strategy and then left it alone long enough for compounding to do the heavy lifting. You started this video thinking you had to choose between cash now and growth later. What you actually have is a spectrum, and every company on it is just standing at a different point in the same story, the story of what a business does with the money it earns.